Hello everyone. Today we are going to talk about bubbles in the stock market by example of US. Let's jump right in. The first chart I want to show you is S&P 500 PE ratio versus historical average since 1950. As you can see on this chart, price and earnings ratio reflects obviously the relation of price to earnings of the company, and it's related to the top 500 companies in US. As you can see in dot-com bubble, this ratio went way up. It means irrational exuberance. People were very excited to buy stocks as they were expecting perpetual growth in a real value, which was false. So many people bought into stocks and they will continue buying, and in some point it became a mania where people were just buying stocks because they were going up and everyone thought that they will never go down. So internet dot-com bubble in 2000 shows very clearly how mania was developing at that time. If you take present time, 2021, we have data by June 11, 2021. We are pretty much on a higher level of mania. Means people buy stocks at a high price earnings ratios, and it's might give you an indication that the stock market is most likely overvalued. Let's look into another chart. The next one is a Wilshire 5000 to GDP ratio. This index was born from a statement of Warren Buffett that how he identifies bubbles and how he identifies if the market is overvalued. So what this index does and what this ratio does, it basically compares the total cap of the stock market in US to US GDP. And you can see again in the dot-com bubble, the market cap for all stock companies in US was around 133% to GDP of United States. As you see right now, it's about 200%. So quite a bit more compared to dot-com bubble, and it gives you another indication that US stock market might be right now in the bubble. You of course need to dig deeper, but it's a very good overview and it's a very good way of general indicator if stock market is overvalued. Another factor I would consider myself with relation to this indicator is the government spending as a percentage of GDP. So think about that. If we're taking stock market cap and we compare it to GDP, we want to also know what GDP consists of, gross domestic product. Because in healthy economy, gross domestic product mainly consists of commercial private sector generating goods and services. Government does not generate goods and services. And the higher percentage of gross domestic product represented by government, the smaller the portion of the private sector in the economy. And it means, like in China, they had a small experiment. They gave a private sector free hand in order to organize themselves and provide certain amount of goods and services. So they had around 5% of private sector. I don't remember the year, but I read in a book about China's history. This 5% of private sector was providing at that time 80% of goods and services by comparison to the government sector. So the planned economy, the government regulated and mandated economy does not have the same incentive it is not as efficient as the private sector. And if you reduce the private sector, you reduce the efficiency of your economy. And then you go basically to the Soviet Union, when if the government spending and the government percentage of GDP grows to nearly 100, it's a basically planned economy where government does everything. And we know how it worked out. So at the present time, the government spending in GDP is around 44%. So if we go back to this indicator and we see that 200% of the capital market cap of the stocks representing 200% of GDP, at the same time, GDP itself, 50% of it consists of government spending, you might get a notion or indicator how overvalued or undervalued the market is. And in this case, it's extremely overvalued. The stock market in the US is extremely overvalued, and it looks like a huge bubble. When it's going to burst, it's a complicated question. And how it's going to happen, it's also another complicated question, maybe for another video, because crisis might come in a different ways. It might come in stagnation, it might come with inflation. As Tolstoy wrote in his book Anna Karenina, every happy family is alike. Every unhappy family is unhappy in its own way. Therefore, there are many ways it can go wrong. Thanks everyone for watching, and see you in the next video. Bye bye.